Halloween's gone, the Christmas lights are up, and the financial industry's festive tradition of delivering hopeless market forecasts to clients has begun. Now, to be fair, fund managers treat the predictions of Wall Street and the City with the scepticism that they deserve. The value of the annual round of prognostication is in the ideas that analysts generate, not the numbers that they throw together on where the FTSE 100 will end next year or what will happen to the oil price. But for those who'd like to go into the business of predicting the stock market, this chart offers a handy how-to guide. What you do is look at where shares are at the start of the year, that's the blue line, add on about a tenth, and ta-da, you have the forecast for where stocks will end the year. This red line here shows the consensus of Wall Street strategists. At that point, you can head for the pub, knowing that the job has been well done. Now, there is one extra rule if you want to be advanced. If the bull market's been underway for a long time, you should up your forecast by a bit. You can see they did that this year, and again 2007, 2008, and in 2000, 2001. Now, doing that doesn't mean it's any more likely to be right, but it does make everyone feel a bit better about buying overpriced stocks. It's a rare analyst, of course, who'll admit to using this method, although in private a few do. But whatever method they use, the outcome is miserable. Here I've put where the market actually ended the year. That's the blue line, although, of course, for this year, it's just the latest point. And against that, again, the forecast. You can see that occasionally analysts do get it right. Back in 2004, 2005, they were very close indeed. But that really looks like luck. Over the past 15 years, they've been out by an average of 12 percentage points a year. That's an error margin bigger than their average prediction of the rise in the market, which was 9%. So effectively, tossing a coin might have come up with a better answer for whether the market was going up or down. Now, it's always enjoyable poking fun at forecasts, but it's also worth considering the themes that are likely to dominate the discussions over the next couple of months, the actual value that there might be in these analyst predictions. Now, there's a widespread belief in a divergence between US monetary policy and that of Europe and Japan. There's also a strong belief that emerging markets haven't yet hit bottom, but that a spreading crisis is probably going to be avoided. Perhaps the most interesting theme, though, will be the debate about where the developed world stands in the economic cycle. Barclays thinks that we're quite late in the cycle, and it says it's grudgingly positive. It suggests the S&P 500 will rise 5% next year, driven mostly by earnings. But the combination of being well advanced in the economic cycle in the US and UK, where unemployment's now back down to pretty much normal levels, but at the same time only just at the start of the monetary cycle, does create some oddities. Barclays predicts that cheap value stocks will beat both more expensive growth shares and stocks in dependable quality companies, as happened the last 3 times the Federal Reserve began raising interest rates. Equally, it's supportive of shares which typically do well late in the cycle. That's things like the beaten-up energy sector, materials and industrials, which lag badly behind the consumer stocks that have been leading the market up. Now, one intuition behind the idea of value winning as rates start to rise is easy enough to understand. The Fed reacts to an improving economy, and at the same time, the improving economy helps struggling companies, which are much more likely to be cheap, rather more than it helps the pricey stocks, which were doing well anyway. In other words, a rising tide lifts all boats. If it turns out to be right, this would make a nice Christmas gift for those poor souls who've suffered 8 solid years of underperformance from global value compared to global growth stocks.